The S&P 500, which represents 500 of the largest US-based companies, has become one of, if not the most popular index to invest in. And for good reason. Its annualized rate of return, including dividends, is in the neighborhood of about 10% since 1926. But at the end of the day, the S&P 500 only represents 500 of the 10,000 plus stocks globally, which means it's probably not as diversified as you might think. This can lead to increased risk, especially in retirement as you rely on your portfolio for income. To demonstrate this, in this video, we're going to discuss an investment period known as the lost decade, how the S&P 500 and other sectors of the market performed during and after this period, as well as a backtest of 3 different portfolios to show you how each one would have fared while taking withdrawals in retirement. Hey everyone, if we haven't met, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors, where my partner Chris and I help people across the country retire with confidence and clarity. So the inspiration for this video came from an article that I came across by Dimensional Fund Advisors called A Tale of 2 Decades, Lessons for Long-Term Investors. And I think it does a great job of driving home this topic of diversification beyond just US large cap stocks. I'll include a link to the article in the description below the video here. But I wanted to start by explaining what is meant by the lost decades. The lost decade refers to the period of the beginning of 2000 to the end of 2009, and how the S&P 500 essentially returned zero. In fact, it was actually down an annualized 0.95% per year over that 10-year period, which is virtually unheard of. When we invest in stocks, we expect positive returns over long periods of time. Like I said, going back to 1926, the average rate of return is about 10%. But the lost decade, again, is where S&P 500 investors essentially did not see any returns over that 10-year period. However, over that same period, as you can see, different sectors of the market did see positive returns. So large cap value stocks, which would be companies that have low relative prices compared to growth stocks. Small cap stocks did very well over this period. International stocks did really well, and emerging markets did very well as well. Now, obviously, I'm not saying pick one of these sectors of the market and invest 100% of your equity portfolio in them either. But if you had any sort of allocation to these other sectors of the market over this period, you would have likely seen positive returns, which, as we'll see in just a moment, can be especially important in retirement. Now, obviously, some of you may be watching this and think, Jake, you're obviously cherry picking data here. You're picking the worst performing period for the S&P 500 and some of the better performing periods of these other sectors. So let's take a look at the decade after the lost decade, which would be from 2010 to the end of 2019. So the S&P 500 since then has outperformed, as you can see, about 13.56% per year on an annualized basis. But these other areas of the stock market have also had pretty strong returns as well, even if they have lagged behind the S&P 500. So the prudent thing to do would be to look at the entire period from 2000 to the end of 2019. So luckily, Dimensional has a chart for this period as well. And as you can see, the S&P 500 is still the lowest performing area of the market from 2000 to 2019. Once again, the US large cap value stocks, small cap stocks, international stocks, and emerging markets all had stronger returns over that 20-year period from 2000 to the end of 2019. So the main point in showing you this article and discussing the lost decade is that when you're retired, you simply cannot afford to see another lost decade by investing only in the S&P 500 for your equity portion of your portfolio. Even if you have a balanced 60-40 portfolio in the S&P 500 and a total US bond market fund, for example, it could leave you exposed to more risk than you might think when compared to diversifying into these other sectors of the market. So for that, let's backtest 3 different portfolios, one fully invested in the S&P 500, another one invested 60-40 in the S&P 500 and a US bond fund, and another one that's spread out into these other sectors of the market, including international funds, small cap, and value stocks. So we're going to start out using the same time period from January 2000 to December 2009. Again, this is known as the lost decade. The first portfolio is going to be 100% in the S&P 500 or US large cap stocks. Portfolio 2 will be 60-40. So once again, S&P 500 is US large cap, total US bond market. And then the third portfolio is going to be a much more diversified portfolio based on a model from Dimensional Fund Advisors. This is similar to the portfolios that I use in my own accounts, as well as accounts for my clients here at Spark Wealth Advisors. So that portfolio would still consist of a portion in the S&P 500, but also a healthy allocation to US small cap value stocks, large cap value, international value, small cap, and then a global bond fund as well. So a couple assumptions before we go over the back test. We have the beginning portfolio balance at $1 million. Again, 2000 to 2009. We'll also look at 2000 to 2019 here in just a moment. We're going to assume the retiree is withdrawing $40,000 per year, and that is adjusted for inflation each year, also known as the 4% rule. We'll also assume that the withdrawal is annual and we'll rebalance the account annually as well. So if we analyze these portfolios, we can take a look to see how they would have performed while taking withdrawals from the accounts as well. So portfolio one is going to be the S&P 500 here, that dark blue line. So portfolio one at the end of the last decade is down to $415,000 after taking those withdrawals. And keep in mind, this is also assuming you've done everything right as an investor. You haven't panicked and gone to cash at any point. You've stayed invested the entire time, which we all know is pretty hard to do, especially when you're retired. Portfolio two has done a little bit better since you have bonds in there. It's prevented some of that drawdown, but you're still down about 27% to $733,000. But as you can see, the balanced portfolio with all of those different sectors in the market, you're up to $1.2 million even after withdrawing that $40,000 a year adjusted for inflation. So once again, not to just cherry pick certain years here, let's look at the bigger picture and see how these portfolios would have done over the 20-year period until 2019. So when we include that decade after the lost decade, in other words, the full 20-year span here where the S&P 500 outperformed all other areas of the market, you might think that portfolio would have done better over the long term, but you'd be wrong. The balanced portfolio ended with over $1.9 million, where the S&P 500 fund is still below $400,000 over that period. And once again, I can't stress this enough, but this is assuming you did everything right as an investor, didn't panic, didn't sell anything, stayed invested the entire time, which as we know is probably pretty difficult as a retiree when you see your portfolio sink almost 70% a few years into retirement. So even these numbers are probably a little optimistic, but the point here is that by diversifying into these other sectors of the market beyond just US large cap stocks, you're probably going to be better fit to weather any sort of stock market storm that you encounter throughout your retirement, whether it be another lost decade or something similar. So I hope this video gave you something to think about if you're someone who's approaching retirement and wondering how your money should be invested. Please keep in mind this is not personalized advice, as I'm not familiar with your unique situation. If you are considering working with a financial advisor, I would be happy to chat with you to see if we're a good fit. There's a link in the description below where you can schedule a free introductory meeting with me. And finally, as we saw when we backtested those retirement portfolios, the 4% rule is okay for illustrative purposes, but in real life, it leaves a lot to be desired. I recorded another video recently picking apart the 4% rule and a better, more modern approach to retirement income. If you want to check out that video, here it is now. Besides that, thank you for joining, and we will see you there.